Greetings, I'm Andrew Ludwig, and welcome to Black Onyx Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe that you, the investor, deserve to be better informed so as to achieve the best risk-adjusted returns. I would like to introduce you to Rowan Williams. He runs the Nautilus Nitrogen Retail Hedge Fund, a low volatility equity long-short strategy established in 2008. Rowan, thank you very much for joining me here. We'd like to learn a bit more about yourself. Give us a bit about your background and how you got into alternative investments.
Yes, certainly. So we have a slightly different background to a number of my colleagues that are in the hedge fund space. I actually studied building science and then did a master's in economics and transferred that into a CFA, and started out my career in management consulting, which I really consider an MBA for business. It was quite useful. Quickly transferred that into private equity fund management, and that was excellent in terms of understanding the fundamentals of investing, particularly in private businesses, and really the fact that investing is about investing in businesses. Ran the private equity fund for a number of years, but realized the private equity space, particularly in South Africa, is quite challenging. And really my skill set and the team's skill set was better suited to the public equity space, which I'd been very involved in, had done a lot of investing in my private capacity, as well as some prop trading, looking at specific situations. And really we took that experience, a combination of the private equity experience, the real world investing, together with some of our on-the-market trading experience, and rolled that up into a hedge fund product, which became known as the Nitrogen Fund, and launched that in late 2008 as a hedge fund offering, long-short hedge fund offering to the South African market.
Rowan, please tell us how our Nitrogen Fund managers got started.
Nitrogen, as I mentioned, I was involved in private equity fund management, and that was actually the firm called iCapital. And I ran what was the fund management operations, initially focused on private equity, called iCapital Fund Managers. It was a business I started in my younger years with my brother and some other colleagues, with some backing from some financial institutions, and cut our teeth in financial markets in South Africa. We ran the private equity fund successfully, raised capital, deployed it, did some less listed equity in the private equity fund as well. And that's really also where we got the idea for the hedge fund. And when the private equity has a fixed life, as the fund was coming to the end of its life, we decided to leverage our skills and the operation in the hedge fund space. The hedge fund space was still emerging in South Africa. This was around 2008. And so we took our skills and we launched the Nitrogen Fund. And so it was under the banner of iCapital. Soon after we started the management of the hedge fund, we realized that it was better suited as an independent operation, and so decided to split the fund management business out from iCapital and reposition the fund management business as Nitrogen Fund Managers, taking the name from the fund which was known as the Nitrogen Fund. And so rebranded the business, reset it up, and grew from there. So I guess it was sort of a new start as Nitrogen Fund Managers. We've had good acceptance in the local marketplace from a number of the fund of hedge funds which have backed us. The fund has grown steadily over the years to a fairly sizable asset base now. And more recently, we decided also to provide access to offshore investors, and so we have a dollar class of the fund as well.
Please give us your definition of a hedge fund, a short explanation on short selling, and how these types of strategies influence downside protection and actively seek alpha.
So from our perspective, a hedge fund is an absolute return vehicle. So the term hedging really refers to the fact that you protect yourself from the downside and are focusing on generating a return profile that is creating absolute returns, importantly in all market conditions. So we're used to equity markets going up, and that's investors remain very happy, but they don't always go up, they also turn down. And it's important that a hedge fund is still able to provide positive returns and protect downside, protect capital. So the term hedging refers to protecting yourself, and we really use the long-short process to achieve that. So most fund managers can go long, that's buying a share and getting exposure to when the share increases in value and getting a return. The process of shorting allows us to sell shares that we don't own and essentially profit in the event that the share price declines. And really that allows us to protect downside, because we are looking for relative returns in terms of the difference between our longs and our shorts. And obviously when markets turn down, the shorts should make money and protect the downside. So it's through that long-short process that we can generate a more certain, more predictable, less risky absolute return profile. And really I think what investors are wanting is that certainty, and they have a certain savings objective and need. They're not really speculating on whether markets are going up or down. That's not their job. They provide us with capital and make us the custodian of that capital, such that we can make sure we generate a return profile that meets their end objective. And that's really our focus in terms of why we manage hedge funds.
Rowan, how exactly is your fund different from other mainstream products and alternative investments?
So as I mentioned, we have a somewhat non-traditional background. I have a background in building and management consulting, private equity, and leverage that into the hedge fund space and some of the trading background. And so we believe we've got a slightly different approach in terms of how we manage money and look to generate those superior risk-adjusted returns that I've mentioned. So we have focused on splitting the book, the portfolio into two separate books. And that is really by duration. If you look at equity markets, they can provide returns in the short term and also in the long term. And so we look through time to take advantage of pricing discrepancies both in the short term and the long term. And we do that by focusing on two separate, distinct books. We have a short-term trading book that really leverages our skills in arbitrage and equity trading to take advantage of short-term price discrepancies. And typically when we think short-term, we are looking 6 months and less, but the average duration of the trades is around 3 weeks. The second part of the book is a long-term fundamental book, which would look much more like a traditional long-short book, where you're looking to take advantage of mispricing, pricing discrepancies, but they may manifest themselves or reward you for holding them for a longer period of time. So typically there we're taking a 2-year view, but again our holding period is probably about a year. So the combination of the two books, they have quite different risk-return characteristics. When you blend them into a single fund, which is the nitrogen fund, it creates a nice smooth return profile and allows us to take advantage of short-term price movements and long-term price movements. So, and we overlay this with a risk management framework. So two things, it's important to remember our process is fundamental in nature. So we look at the market from a fundamental perspective. That means gaining a first principles understanding to each and every stock that we invest in and trade, whether we long or short that trade or that stock. So we do a lot of work understanding the company, how it makes its money, whether it has a strong business model or potentially a weak business model that we can take advantage of. But also importantly, how the share reacts to different market environments and different market conditions. If you're trading for the short term, it's important to know or understand and predict to some extent how you think a share may behave in those market environments so you can take advantage of it. What's particularly powerful is we actually look for structural situations that we can predict. And these are typically things like listed corporate structures, dual entry points into the same type of asset. We also trade in corporate actions where you've got merger arbitrage in announced transactions. and event-driven situations as well. So that's more focused on the short-term trading. And those trades tend to be market neutral in nature, which means your value of your longs equals the values of your shorts. So you're really focusing on relative value there. And that's very much less dependent on market movements. Markets could go up and down, you hedged, and so you should be able to generate returns no matter what the environment. What's also important in terms of the characteristic of that book, or that trading book, is that as markets get more volatile, what you find is dislocations, pricing discrepancies increase. They increase in frequency and amplitude. So typically, we're able to profit from difficult market environments. And there's a high correlation between increasing volatility and declining markets. And as we've said, a hedge fund likes to try and make money or protect the downside in those declining markets. And so we're able to trade in this hedged fashion and generate returns. And then the long-term book is much more focused on fundamental stock picking. So that's where you identify stocks that are mispriced for the medium term on a bottom-up basis, and you're buying individual stocks. But again, that book would be hedged. We'd have longs, select longs, stocks that we think are cheap on a risk-adjusted basis and will increase in value over time. Also stocks that we think are expensive, are overpriced, will underperform market expectations, and will decrease in value over time. Because to make value from an absolute long, a short, you have to, the short has to go down in absolute terms. In terms of stock price. And then what we use is a risk management framework called the Kelly criterion. So this is very interesting. It comes actually from information theory, and it was popularized actually by initially Edward Thorpe, who wrote the seminal book called Beat the Dealer, which was a book focused on blackjack and being able to count cards and vary the bet in your favor when the odds were essentially in your favor. So, but it's quite an intuitive framework. Essentially is what you use. It is to allocate capital in the form of exposure to trades and positions where you believe as an investor and a strong analyst is that the odds are vastly in your favor, and that means that you have a higher level of confidence that something is mispriced. So in order for us to do that and rigorously apply this framework, we need to do the analysis to determine what we believe the returns are and then what is the probability of achieving those returns. As I mentioned, that whole class of structural trades that we do, we've done a lot of fundamental work on the trades. And then we've also analyzed how those trades behave in different market conditions. So important that what our model predicts and what the market behavior is, there's a high correlation. That gives us the certainty that when we see mispricing from our model, that we can take advantage of this, such that if we put on a position on this particular trade, there's a high probability that we will achieve our expected return. And it typically is in a fairly short time frame. And importantly, the market behavior translates into what we predict, and so we're able to put the trade on, as I mentioned, a fairly short holding period, average of around 3 weeks, and you're typically taking fairly small gaps of between 1 and up to 5%. So, but if you can take that within a month, that can translate, if you annualize that, to fairly significant returns. So that trading book gives a nice base return, which is then supplemented by the long-short book, which is inherently a little bit more volatile. So more absolute returns from the short-term trading book, and then a slightly more volatile return profile from the long-term fundamental book, but all put together creates a very smooth return profile that achieves our risk-adjusted returns that we're looking to deliver to our investors.
Rowan, thank you for sharing that detail and giving us a better understanding of your fund. And thank you for tuning into Black Onyx. For more information, please visit our website.